So let's fast forward now to today, coming back to the whole, co-lending space where you're seeing a lot of momentum with the larger banks, right? Um, what is co-lending at a high level, right? We talked a little bit about partnering with NBFCs and fintechs, but co-lending itself, why is it so nuanced, and why are existing, banks have been having loan management systems and platforms and AI-based system for underwriting risk and things like that for the past, several years. Why has co-lending become such a difficult problem to solve, and why does it need, new infrastructure to address the challenges?
Right. So I think let's maybe go step by step that what the co-lending is, why the kind of there's a lot of momentum from across the board, whether it's a regulatory, government, top management, or everybody, why the entire business is trying to chase co-lending, and then what are the specific challenges into co-lending and how tech can solve for it, right? So if we speak very simply, in simple terms, for co-lending, you can have a narrow definition and a broader definition. So in the narrowest definition, co-lending, we are talking about where the two lenders are joining hands and lending together, right? One is the NBFC and other is a bank. They would have, a pre-agreed lending framework. So they agree to basically source and lend into a pre-agreed risk framework. The risk policy is agreed upon, works slightly differently than into a DSA model, where DSA is sourcing into certain fashion and the bank, where the rejection rates could be significantly higher. Now, co-lending, since the risk policy is agreed, they are sourcing within that policy, and probably, as long as the NBFC is sourcing into the within the risk framework, the bank is
So
going
let's
to
take an
sanction.
example, perhaps, of an NBFC that
Yeah.
is selling me a two-wheeler loan, right, or a car loan,
Mm.
for example, right? What you're
Mm.
saying here is actually, if it's a car loan for say 10 lakh rupees,
Mm.
perhaps 3 lakh rupees is coming from the NBFC and 7 lakh rupees is coming from a partner bank or something like that. And
Correct.
what would have happened is, even prior to starting to look for me as a client, they would have agreed that the certain CIBIL score has got to be this, income level has got to be this, etc. Five, six different criteria. And
Correct.
so even for the NBFC to partake in that 30% of the loan, they know that the client has met all the bank's criteria also, right? And or
Absolutely.
the common shared criteria. And that's when there's a high likelihood that the bank will also approve.
Absolutely. So typically, we have seen the see-through rate when if a DSA sources 100, probably 20 gets through, 80 gets rejected. In a co-lending model, because it's a pre-agreed risk framework, so out of 100, probably 99 will go through. So that's a kind
Got
of
it.
a difference, right? There are very interesting, kind of market dynamics if you actually try to understand. So if you look at the basically the recent past, so there were different models that used to exist, right? So we had the FLDG kind of models, we had the business correspondent models on one side of the spectrum, and then we had the other spectrums in terms of the pool buyout, right? So where the banks used to buy out the assets. So banks have their targets to build their PSL. So they have the PSL norms also to complete, right? So typically, if they are not comfortable in building the PSL, or if they do not have the certain expertise, naturally they used to buy the PSL also. They used to buy the assets also. So on one hand, there were the asset purchases where the pool, asset buyout, securitization, credit enhancement, where you create a kind of an SPV where you do a credit rating enhancement. So all of those kind of models were existing. On the other hand, we have this 100-0 kind of a models of the DSAs, FLDG, and BCs. And then you have a co-origination, co-sourcing kind of model. So in an extended definition, all of this falls into a single ambit, and we are able to attack this entire ambit of things. And why on one side the FLDG is becoming difficult and difficult, as we all understand the kind of the new regulatory tightening happening on that side. On the other side, even from the traditional pool buyout or the securitization, the RBI came up with the new norms where the individual account level information has to be maintained in the core banking system. That
Mhm.
started so the lines started to blur, where in a kind of a classic co-lending where you are doing everything at the account level, at the borrower level, vis-a-vis now even into the traditional pool buyout also you have to do the same thing. And while in the FLDG you cannot do that. The other interesting thing from the co-lending perspective, we would see from a leverage perspective. So NBFCs, they have a lot to gain because obviously they are able to build, and even from the overall ecosystem perspective, I would say, I think that is the fundamental corner that why there is a lot of momentum, right? And across the value chain, whether it's an NBFC or a bank or the customer, all three parties win.
Mhm.
From an NBF from an NBFC perspective, if there is a mid-sized NBFC having maybe 500 crores of assets, goes to a bank from a borrowing perspective, to basically raise the money. So the bank is going to look at their credit rating, they're going to look at the vintage, they're going to look at the rating and all of that. So most of the NBFCs will not make the cut. Even if they make the cut, the bank probably will not take more than 50 crores of exposure because they're taking a direct exposure to an NBFC. Now they might lend at, let's say, 12%, 13%, whatever is the number. And then in NBFC, they do not even have a direct control to what risk NBFC is taking. Right? So the NBFC might be building a book on 25% risk or 30% risk also on the same thing. So at the end of the day, bank has an indirect risk, but at the same time, the return is limited to the same 12, 14%. And the capacity that they can give to NBFC is probably not more than 50 on 500. Come on co-lending with the new regulatory guidelines which came. So essentially, the counterparty risk has been transferred from the NBFC balance sheet to the end borrower, because now the same NBFC can source n number of applications and can build a large book as long as it is meeting the pre-qualified criteria. And theoretically, the same relationship can actually build a 2,500 crore book, wherein the NBFC has 500, bank has 2,000, the collective 2,500 crore balance sheet. So 50 could become 2,500. That is the kind of impact this relationship could do. And that is one of the reason why the regulators and the government see as the biggest tool in terms of solving credit gap problem. Because there are
Mm.
large number of fintechs and NBFCs who are good in sourcing, who have a very good distribution, who have very good collection, who have a very good underwriting, but they do not have the capital. And to raise
Correct.
the capital, they need to raise more capital, because for NBFC to lend, they have to first raise, then they can lend it. There is an equity and all of those things come into play. On the bank
Correct.
side, banks are sitting on collectively over 135 lakh crores in assets. Almost one third, close to one third of that goes to the treasury markets. So they
Mhm.
are already sitting on at least 10 to 15 lakh crores of dry powder. So now there has to be a framework which enables the two parties to do together. So a regulatory framework which is now already there, and then there are hundreds of technical and operational challenges. That is what we are solving for. So if we build those roads and pipes, and we make this process frictionless, there's a lot of volume which can flow through these pipes, and the commercialization is certain basis points. You gave the example of the for example, payment, right? So it is somewhat analogous to that, but at the same time it's slightly deeper into that, because we are not just the where we are kind of enabling moving from point A to point B, but actually it's a full service stack. So if a loan is sourced into the middleware, let's say a housing loan, if it is a tenure of 15 years, during that 15 years, everything that happens into that loan, whether it's
Mm.
an interest rate
Mm.
reset, part prepayment, foreclosure, everything which is happening onto that is going to be managed by this middleware.
So
So it is
if a payment processing is more of a transaction or at a snapshot, here it is really a life cycle, and it's the entire video that is sort of being managed on your platform here.
true.
Because the relationship with the customer is not at a point in time, it's over a period of time.
Absolutely. And because the NBFC systems are, as you mentioned, that most of the NBFCs and banks, they have their own system. Banks have their own Finacle, TCS, Oracle, etc. NBFCs would have their own systems like Nucleus and other systems. But these systems
Mhm.
don't talk to each other, and they can't talk to each other, right? Because they have their own security policies and everything, and it's kind of they cannot directly communicate to each other. That is where the middleware comes into play, where it kinds of gets deeply integrated on one side with bank, another side with the NBFCs. And then basically it starts, that it enables that the two parties who have all the willingness to do, where they have the regulatory push also, as well as where they have the bank's management also. It's very profitable business, because when they get into a co-lending, for NBFC, the cost of borrowing goes down effectively by at least 200, 300 basis points.
And
So
for
their
banks, the
effect
cost of sourcing goes down.
Correct. For bank, the cost of sourcing goes down. They're able to expand the revenue also, because now they're operating into a certain territory that probably they didn't do before. So they might be
Mm.
doing at 9 to 12% of the loans. Now they're doing probably 14, 15% loans, right? So they're also having the increased ROI. They're able to expand the business into certain territories, which where the NBFCs are, they are more expert, while the banks might not be, right? For example, we built an healthcare finance, like as a kind of a new vertical only we built in for a bank in the NBFCs. So certain categories where they are not specialized, while the NBFCs are specialized. So they're able to build new capabilities. They're able to open new markets. They're able to lend at the higher rates. So bank has the direct revenue incentives. The NBFCs have the incentives because the ROI almost doubles. The 15-16% ROI becomes 30% ROI. And the customer also gets benefited because certain benefits because of the lower cost gets passed on to the customer. So he also saves 50 or 100 basis points. And then the entire ecosystem becomes more competitive. So if let's say 10 NBFCs start to do a co-lending, then there is a network effect. Then other NBFCs
Mhm.
have to do that to either get the benefits or at the least become as competitive as their competition. So then the whole ecosystem starts to drive together.